Hi everyone. Today I'm going to talk about my favorite high yielding covered call ETFs. So, for those of you who aren't familiar, a covered call ETF is essentially an ETF who holds a basket of stocks, but then will also write call options on those stocks to enhance the income potential of the security. Um, Covered call ETFs are a great tool for people who are willing to sacrifice a portion of the upside and capital appreciation for a higher dividend, higher income on a month to month basis. And then they can use this higher income to, average into more stocks or do whatever they please with it. The interesting thing about covered call ETFs is when you look over time, they actually tend to be um, not as risky as owning straight securities because in an environment where the market's downtrending, you're actually still getting that enhanced yield because you're still receiving the same premiums for selling the upside. So you're getting the premium from selling the upside to offset some of the downwards pressure in stocks in that type of environment. Obviously that's offset by when the market's going up a lot, you're selling some of that upside so you're not capturing all of it. But part of it really depends on what kind of ETFs you guys are invested in. All of them are set up a bit differently. Um, some of them, or most of them, I think all of the ones we talked about today, only write call options on up to 33% of the portfolio, which means you're going to be getting minimum 2/3 of the upside appreciation in an environment that the market's going up a lot. Um, and then other ones use a bit of leverage as well to enhance yield. There's one specifically that we're talking about that I think does that more than the others. So yeah, we're gonna jump into it here. If you don't mind taking a minute to like this video, subscribe, comment if you have any questions or thoughts on any of these ETFs, I'd appreciate it a lot. Okay, number 5. The first ETF I want to talk about today is the BMO Canadian High Dividend Covered Call ETF, ticker ZWC. So this ETF pays out about a 7% dividend, has a management fee that's on the high end of about 0.7%. In general, covered call ETFs tend to have higher management fees just because they are actively managed. They do have to go in, write these calls, manage the book a bit more than just a normal ETF. So this is average for a covered call ETF. But yeah, definitely worth noting that the management fees are a bit higher. But you're essentially getting a 7% dividend yield on just high dividend stocks in Canada. So, think Canadian banks, energy companies, technology, utility companies, stuff like that. So we can go through that in a minute. But it's a good overall Canadian portfolio ETF if you just want to get your return upfront in dividends and not over as much time. So going into that diversification, this ETF is very diversified, but all within Canada, just given the nature of the type of security it is. It's a Canadian dividend ETF. So you're not getting any international exposure here. So I think it's a good covered call ETF to have, but definitely should be paired with other exposure, whether other ETFs or just straight equities that hit other markets as well. But within Canada, it's very well diversified. You can kind of see its top holdings, some big companies there that you're probably familiar with if you're used to investing in the Canadian market. So CN Rail, Royal Bank, TD, Manulife, Enbridge, Bell, etc. So these are, companies who've been paying dividends for decades. Lots of them have been raising dividends for decades, which also enhances yield over time on these ETFs. From a sector allocation standpoint, they're also pretty well representative, I'd say, of the Canadian market. Very heavy on financials, energy, but then you're still getting industrials, materials, consumer staples to a lesser degree. So, well diversified Canadian option that doesn't really hit outside of the borders. I'd say over the last 5 years, the performance of ZWC has been very average. Um, they've gone from about $10,000 if you invested $10,000 5 years ago to just over $12,000. So, like a 4.5% return overall. Um, this isn't great performance. The Canadian markets have lagged a bit in general, I believe, as well. But this definitely has been very average at best when looking back 5 years. Okay, moving on to the fourth ETF here. Um, Life, which is an Evolve ETF, is a global healthcare enhanced yield fund. So this ETF says it targets about 7% yield, but they've actually recently increased their distributions and it's currently 8.7% yield. And they actually have a smaller management fee, so just under 0.5% on this ETF. Like it says in the title, and you'll see on the next slide. Oh, misplaced that. Um, this ETF holds healthcare companies from around the world. So European healthcare companies, US healthcare companies, almost has no Canadian exposure. But you'll see some big names on here like Pfizer, Novartis, AstraZeneca, Eli Lilly, J&J, Abbott, AbbVie. So it's a very similar strategy. They take the dividend from all these securities, but then they also sell some of the upside in options that really enhance it to get you to that 7-8% dividend yield. And on this security, they do have good diversification, like I was saying, 60% in the US, but then 40%, which is mostly across Europe. So for Canadian investors who are looking for some exposure to the US and Europe on a Canadian denominated um, security, this is a great option if income is a priority for you. This stock has actually had very strong returns over the last 5 years. So looking on the left-hand side, what's interesting is you'll see the stock price is up just about 10, just over 10%, give or take. But over that same time period, if you look at the cumulative returns, it's up about 60%. So this really shows how getting that income up front and getting it somewhat guaranteed from those 7, 8, 9% yields really offsets the need for significant capital appreciation. You can still get a very strong overall cumulative return on your investment over time. Okay, moving to the third ETF, HUTL or HUTL, however you want to pronounce it, is the Harvest Global Utility Income Fund. So this one currently has about a 9% yield, 0.5% management fee. All of these funds pay monthly distributions, by the way. This one is very similar to the Evolve Life ETF, where it's globally diversified as well. So you get lots of exposure to outside of the border. The holdings are very diverse across oil, gas, energy, utilities, communications. So all types of utilities across both Canada, the US, and internationally. So just reading off a couple of names here, you have like Kinder Morgan, Pembina, Enbridge, AT&T, Bell, Duke Energy. So you really get a good scope across the utility sector, both segments of the utility sector, but also geographies. And that's really well captured here. So electric utilities, communications, oil and gas, etc. You really get about a fair share of it all. And then in terms of diversification, 60% North America, 40%, which is mostly Europe. Overall returns on this one have been, I'd say, very average as well over the long term, about a 4 to 5% return. So these ebb and flow with the total markets. They were up a lot more earlier in the year, obviously, but the underlying assets are still equities, and especially equities that have high debt loads, like utility companies, haven't been performing as well, aside from the gas companies specifically, or the oil companies specifically, rather. Um, so that kind of comes with the territory when you're dealing with a bit of leverage, dealing with higher interest rates, and you have underlying securities that have high debt loads relative to their earnings. It puts some pressure on the stocks, and that's flown through to the covered call ETFs as well. Okay, number two on the list of the top five, HDIF. So this is also a Harvest ETF. It's the Harvest Diversified Monthly Income Fund. So Harvest is an ETF provider who has about half a dozen different covered call ETFs. And this is a fund that puts all of their ETFs together and applies about 25% leverage to really enhance the yield. So this company, or this ETF, is currently paying about a 12% dividend yield. They say they have no management fee, but it's very misleading because they're buying their other ETFs, which do have a management fee of about 0.6%. So that's kind of flowing through to you at the end of the day. They target about a 10% yield, but they're currently paying closer to 12, I believe. As I said, they just hold all these different ETFs. So you get a lot of diversification here if that's what you're looking for. If you don't want to focus on one segment, you're getting exposure to their healthcare ETF, their US bank ETF, their utility ETF, which we just talked on the last few slides, brand leaders. So they have companies like Visa, McDonald's, Apple, etc. in that fund. Canadian equity income leaders, which is similar to ZWC that we talked off the bat, and then tech achievers. So this is just like the NASDAQ 100 top companies essentially that they're writing calls on. So you get a bit of everything here. Not very focused, but just like a very good general ETF, especially if you're comfortable with the 25% leverage that they put on. The stock doesn't necessarily have performance just because it just got launched 6 or 7 months ago, I believe, or earlier in 2022. But this is just kind of a summary of when it did launch, the components of it to a greater extent. So they're all equally weighted, give or take. And at the time of launch, I think it was about a 10.5 current yield. Like I said, that's currently at about 12% since the market's gone down this year. So a good option for someone who is maybe looking for an even higher level of yield, very high income coming in, and a bit more of a risk appetite to deal with that 25% leverage on the portfolio. So at least like both geographically, you're getting a lot of exposure here, but you're also getting pretty good sector exposure as well. Healthcare, IT, communications, energy, down the list. You're really getting it all here as well. So this is a good, just broad ETF for covered calls that hits everything across the board and has a high payout. But since it does have that debt exposure in a downtrending market, this is a bit more risky than some of the other ones we talked today. Okay, last ETF I wanted to go through today was ZWB. So ZWB is a BMO Canadian Bank Covered Call ETF. Currently has a 7.3% dividend yield, 0.7% management fee. The Canadian banks historically have increased dividends every year, and there's a lot of interest in them. Big companies, big call buying market. So on these Canadian bank ETFs, you typically tend to not only get a high dividend yield starting, so 7.3 in this case, but when they increase their yields every year, that tends to flow through to some extent to the ETF. So I've held this ETF for a number of years. I usually get an annual increase on the distribution every month. So that's another thing. It's high, but it can also grow, which is great to see. This is just the weightings. Nothing surprising here if you're familiar with the Canadian financial industry. You got all the big banks: TD, Royal, Bank of Montreal, Nova Scotia, CIBC, etc. And they just write covered calls on each of these constantly. So similar to ZWC, you're getting pretty niche here, where you're specifically in one geography, specifically in one sector. So this is really a bet on Canadian bank stocks. You're not really trying to achieve diversification with this play, but the Canadian banks over time have performed so well, and held up through recessions and everything else, that if you were to focus on one area within the market, especially if you want some Canadian exposure or more Canadian exposure, this would not be a bad place to look. So I still think it's a great option for consideration if you're looking into covered call ETFs. And then, as I was kind of alluding to before, with how strong the Canadian banks have been over the last 10 years, you probably would have went from about 10,000 to over $20,000 if invested in this. So this has provided a return of probably low double digits over the long term, paired with the dividend growth, but then also some capital appreciation along the way as the bank stocks have trended up. Yeah, so that's all I have for you today. Let me know if you guys are invested in covered call ETFs, what your thoughts, perceptions of covered call ETFs are. If there's other ETFs, covered call ETFs that you guys like or are looking into that I didn't mention here today, always interested in this space. I think covered call ETFs are a great option just to fuel income growth of your portfolio, whether or not you need it to pay bills or support yourself, or you're taking that money to invest in other high growth opportunities within your portfolio. I think it really gives you some flexibility, and the opportunity to just have a lot more cash flow flowing in. So I personally like the covered calls portion of my portfolio. Interested to hear if any of you guys have a different opinion.